Nio, it seems always disappointed us, right? But always seem to find a way to bounce back. But today, I want to see this time feels different. As someone who's been closely following the news journey, I believe that 2024 could very well be the year of its resurgence. Why do I see that? Because all the favorable factors are coming together. Don't rush, my friend. Let me break it down for you. I'm just seeing a transformation within Nio itself. But I'm also looking at the broader landscape of the whole EV industry. And let's widen our lens a bit to consider the overall trend of Chinese concept stocks. If you're interested in Nio, you don't want to miss what I have to share today. Hi, I'm Sheila Wang. I'm here to update it on the most cutting edge and fresh business and investment information for you. So don't forget to smash that like button and subscribe my channel. I also welcome you to join the discussion in the comment section below. Now, let's dive into today's topic together. For those of my long-term followers, you may know that Nio's biggest challenges have been its persistent losses. The stock price has plummeted from a high of $60 per share in 2021 to a dismal low of $3 this year. It's been a top ride, right? However, a turning point came when Nio released its second quarter operating results. We saw the revenue hit 27.35 billion yuan in the first half of the year, with second quarter revenue soaring to 17.55 billion yuan, marking year-on-year growth on 40.3% and an astonishing 98.9% respectively. Plus, the second quarter losses shrank by 16.7%. This improved performance earned Nio a renewed stamp of approval from the institutions in the highly rational US and Hong Kong market. So why has the market shifted from bearish to bullish? From my point of view, a series of changes have led investors to see a clear and certain pathway to Nio's comeback. Well, but what does this certainty mean? We need to dive into Nio's second quarter report, especially what the shrinking losses signify. If you take a quick look at Nio's past financials, it's clear that the root of their losses lies in the vehicle sales. The gross profit from their core business has been too low, unable to cover sales, management expenses, research and development costs, or even the investments in charging infrastructure. In simpler terms, they've been earning too little while spending too much. It seems like their CEO and founder Li Bin has heard our criticism and is starting to rethinking the business strategy. Ultimately, he opted to adjust the operating strategy at this crucial point in the first quarter of 2024. So, what kind of key operational adjustment that has really made an impact on Nio's financial performance? My friend, you'd better update this info with you. Let's see it. First up, Nio rolled out its new battery as a service policy in mid-March, slashing battery rental fees. This clever pricing strategy doesn't just boost the sales, it's also won over existing owners. And we can see Nio sales rolled, ramping up monthly sales to staggering 20,000 units and a rolling monthly average of 60,000 units. With that sales rebound, Nio's gross margin for vehicle sales shot up to 12.2% in the second quarter, showcasing their ability to scale effectively. Third quarter delivery guidance of 61,000 to 63,000 units is a testament to their confidence in boosting sales, which should lead to even higher gross margins and solid third quarter results. Next, in mid-May, they launched their second brand, nio.hk, targeting the mainstream family market, with the first model, the nio.hk L6, starting deliveries at the end of September, priced at just 206,000 yuan, with further reductions for rentals. This move is a game changer for price-sensitive consumers. According to official sources, nio.hk will introduce a 6 to 7-seat SUV next year, plus a third brand aimed at the entry-level market, This means NIO will have a product lineup covering price from 140,000 to 800,000 yuan, flexibly addressing market demands and ensuring stable sales and performance. This is quite a shift from the founder Li Bing's previous focus on being a premium brand. It's clear that in business, as in life, being practical pays off.
Nice.
As the wise Warren Buffett once said, investing is about trusting the character of manager, and that's spot on. A mutual business leader is worth their weight in gold. There's a saying, when you start to help yourself, the whole world will come to help you. And NIO is just on this way. And yes, in 2024, NIO is riding a bit of luck. On the 4th of the month, NIO announced a strategic investment agreement with 3 existing shareholders of NIO China, Hefei Jianheng New Energy Vehicle Investment Fund, Anhui High-Tech Industry Investment Company, and Guotou Investment Management. They're pulling in 3.3 billion yuan in cash for NIO shares, while NIO itself will invest 10 billion yuan. What does this mean? State-backed funding is on the rise. In China, having a big tree to lean on is a huge advantage. So you can just think about that, my friend. On top of that, NIO signed a strategic cooperation agreement with the investor EYVN to establish an advanced tech R&D center in Abu Dhabi. If you've been following my updates, you will know EYVN invested $3 billion in NIO last year, right? This new R&D center will focus on smart driving and AI tech, expanding NIO's global R&D footprint and boosting innovation in the Middle East and North Africa. NIO and EYVN are even collaborating on a new model tailored for the local market, catering to a growing demand for smart EVs. The Middle East and North Africa are becoming strategic markets for NIO, and the Chinese smart EVs are gaining traction there. A bigger map for the NIO. Do you still remember our theme today? Yeah, NIO is set to make 2024 a pivotal year, and I have another piece of evidence to back that up. The macroeconomic trends are shifting in their favor. What do I mean by that? We all know the current economic landscape is a bit rocky, right? The financial tug-of-war between the US and China has reached a boiling point, and both countries have their own economic issues and need urgent attention. For the US, the interest rate hikes over the past couple of years have pulled in global capital like a magnet. But let's be real, this aggressive rate-raising strategy has put immense pressure on economies. Meanwhile, the US finds itself in a bit of pickle. If they keep lowering rates, it's like handing China a lifeline, boosting their asset recovery. But if they hold a line, those high rates might just crush the US economy under the weight of massive debt interest payments. So a rate cut seems like it's on the horizon. This overarching trend is actually providing a tailwind for Chinese assets. The Chinese government is rolling out a series of economic stimulus measures, including new policies aimed at boosting automobile consumption. And guess what? NIO has jumped on the bandwagon with a generous subsidy of up to 600 million yuan. This kind of strategy could significantly boost the NIO's sales. And we just cannot wait to see how this all unfolds. I will keep a close eye on tracking on the latest information about the NIO. If you want to get my deep analysis report, you can check the link below. We have to see. NIO has never been short on luck, but this time, we are all hoping they let their performance do the talking and build a solid foundation for the long-term success. That's all for today. I hope it's useful as usual. See you next time.